Welcome to the Mortgage Brothers Podcast. I'm Eddie Knoell.
And I'm Tom Knoell.
Welcome, everyone. It is our 6th podcast. We're still counting, so hey, it's 6, and I'm excited, Tom. We made it to 6.
We made it to 6. Do we have more than 6 followers, you think?
I think we're our dozen followers or so on iTunes and YouTube.
Awesome.
So it's growing every day.
What do they say? Niagara Falls started with just a drop.
That's right. So, all right. So hopefully we don't lose any people today, but I think that this is an exciting. I think it's forget about exciting, right? Mortgages aren't exciting, but
we're going to take something very technical and we're going to boil it down in very human terms.
That's
right. we are excited about that. Yeah. Making the unhuman human.
That I like it. And so right to the point here. What are points? Customers are asking us about points, buy down points, buy down rate. How does it work? What is it?
Hey, Tom, what are your points? What do you guys charge?
Right.
Are there points? Points. Right. All we hear, points.
That's right. Any old school borrowers out there who were getting loans, especially in the 70s, 80s, even 90s. Points were so common that it really comes from that generation. I think the customers are hearing it from their dads and their moms, and you know
right.
what I mean. Hey, right. Make sure to ask that lender how many points they're charging.
Right? How many points are those guys going to make off you?
Yeah.
So I think we're going to cover that at the end, but let's just at the very, very beginning say the points of the old days are gone. There are very few lenders and very few exceptions to that. But for the most part, anytime you talk to the Mortgage Brothers team at Signature Home Loans, we will always basically tell you that points, and we'll explain what they are. But they really have nothing to do with what the lender makes. Zero. So, you mind if I just jump into it real quick, Ed?
Yeah, and if you want, I'll start. I can ask you some of the questions. I know that we didn't rehearse this necessarily, but we do know what we were going to talk about. But
okay,
I think start off with what's an interest rate.
All right, how simple of a question is that? What is an interest rate? It's simply what do we say? It's simply something that is being paid to someone else because you are borrowing money. That's it. That's all an interest rate is. And probably 99.8% of you know that. But just in case, interest rate is just simply paying somebody for something that you're using of theirs. That's it. I came up with an example of it's like using someone's car. You wouldn't use their car and give their car back to them empty, at least empty with gas or with no compensation. You'd pay them something, fruit basket, something. So you're just simply paying someone for a favor that they've done. In the case of mortgage, someone's giving you their money. You're giving them interest in return.
Yeah. And it's funny. I don't know if you've had this conversation with your kids or how many times you have, but whenever I had the opportunity, I actually try to explain to the kids how interest works. And it takes a while. It takes a while for them to understand. But again, it's as old as humanity.
That's right. It is almost as probably old as dirt, old as the caveman, at least.
That's right.
Okay. Next, I think we're going to talk about what do interest rates look like? And someone may say, boy, that was even dumber than the first thing that you brought up. But really the answer in what interest rates look like is really the answer to this podcast, which is interest rates look the way they are to keep it simple. So every time Ed and I quote an interest rate, it's always done on basically what we call an 1/8% increment, 4%, 4 1/8. 4 2/8, or which is, I'm sorry, I should say 4%, 4.125, 4.25, 4.375. You'll never hear us say 4.286754.
Right.
Always quote on 1/8 increments.
Now, I will say, the audience might see rates out there that are not using those, in those increments, but it's very rare.
Super rare. Super rare.
In increments of an eighth, that is like 99% of all mortgages.
Right. Right. And if you go to someone's house for a cocktail party and they say, "Hey, what's your interest rate? What'd you get from the Mortgage Brothers team?" You'll never say, 4.625821. You'll say, 4.25, or we were 3.99 or 4.99. That's really the only time that we deviate from the 8% increments is when you
Yeah,
do a 0.99.
that's
But
right.
so basically what we were trying to come up with was, how do we describe points? Points are basically what is the filler, the in between those eighth percent increments. The market moves. The market moves 1/8, 1/16, 1/32, 1/64. Well, how does the market translate that into an interest rate for you? Again, they don't come back to you and say your interest rate yesterday was 4.125, but today it's going to be, 4.125674. So there's little, it's like a little shock absorber. When the market goes up, when the market goes down, there's either a charge or there is a credit. And I think I came up with the analogy of baking. When you bake, you're not baking literally to the 1/64th of a cup. Usually it's what? An eighth of a cup, quarter of
Yeah,
a cup.
right. I think that most, when measuring cups, of course, if you just don't think about teaspoons in this analogy,
Right.
just
Right.
quarter, half, three-quarter, one cup.
That's right.
Yeah.
So we quote as if we're baking, as if we're baking.
Yeah.
The reality is this is money, and because money is money, every speck of sugar, every speck of a cent or a half of a cent or a mill of a cent is counted.
That's
So,
right.
so it's not like we're just, bankers or lenders or investors are just, going the baking route, which is close enough. No, everything is measured to the nth degree, which is where the true definition of points comes from.
Yeah. And I'll just say, to piggyback on that when every day, at every moment, the market is trading and interest rates don't go up or down an eighth, just like one big clunk of a click, right? Click, they're up higher, they're 4.25. Click, they're back down at 4%. No,
Right.
they're moving in tiny percentage points. We call them 1 basis point. So, 1/100th of a percent. I mean, they're moving so small that the consumer is never dealing with that. As a consumer, you would only hear lenders speak of rates, of course, like as you said, in the increments. But the banks are watching every small
Every small,
every
right.
small movement.
That's right. And I remember, actually, I used to call, and I would ask years ago, what are interest rates today? And I always thought that they moved in 1/8 increments. So
Right.
that was another reason why I thought it'd be important for us to cover this topic today, because I'm a highly intelligent individual, and
That-
and and yeah, I don't know about that, but even I thought interest rates literally moved at an eighth of a percent, every day. So okay, what else?
So I'm going to set you up then with another question because I think there's another follow up on this. So let's say the market today is 4.25.
Okay.
Wait, you didn't mention about par yet. Oh
No, yeah. Why don't you talk about par? So if
okay.
if Jane were to call you today and she'd say, Ed, what are my interest rates today?
Yeah. And let's just say today they're 4.25 or 4.25. And I said, there's no points. What I mean is that is at par. The bank is not asking for any premium. There's nothing. There's no points to that.
Okay.
All right.
Okay. 0 points. Now, and just to confirm again, points are not what the bank is making. It's just what that interest rate costs. So if you walked into an interest rate store and you were to say, "Oh, look at that shiny 4.25 interest rate. What's that cost?" They'd say, "Hey, it's actually it's only 4.25. You don't have to pay us anything extra for it."
Right.
Okay.
Yeah. Zero premium. If you just pay the bank 4.25, they'll give it to you, and
you walk out.
That pretty 4.25 is all yours.
That's right. Now, let's say you go into the same interest rate store, and it's the very next day. And Ed, let's say that you say the market just went down a little bit, so the market got better for the borrower. Okay, and you walk into that store, and you were to see a 4.25% shiny interest rate. What would that mean?
Okay. And if the market got a little better?
If the market got better.
Okay. So all of a sudden, the bank's going to say, all right, that deal, that 4.25, we'll give it to you. Plus, we'll give you a little credit.
What?
Yeah. We're going to give you a $40 credit because today, well, maybe you want to, but basically, the market is now, we've already calculated what the bank has already calculated the profit they want on the loan. That 4.25, they'll give it to the borrower, and it's improved, but not enough to move it 1/8%, right? Because we're talking about in increments.
It'd have to move a very lot in order for it to
right. It would have to move a lot. So when it moves a little bit, it improves. We'll say there's a lender credit.
Mm-hmm. Okay, so good.
Let's just say it's $40. Now, what if it? And the opposite is true. What if the market deteriorates a little bit, gets a little worse? I could tell the borrower, you're going to get the banker is going to give you this 4.25, but they're going to ask for a premium of about $40 for that today.
Right. Okay. And let's say they wait a month, and rates have actually moved quite a bit. So they've moved, more than an eighth. And they walk in and they say, you know what? Okay, there's that shiny 4.25 rate you quoted me, Ed. I want that at par again. And it's a month later.
And they want 4.125%,
or they want the 4.25, 4.25. Mm-hmm. But now let's say rates are 4.5.
Right.
So when the borrower calls you, what do you say to him?
Okay, you walk into that store and you say, I want the 4.25. The bank said, hey, we'll give you the 4.25. Here it is. But that 4.25, in order for the bank to make the same amount of profit as it did, for example, a month ago, the point is the value of that 4.25 has a premium of, let's just say, a whole point. Okay.
Right.
And a whole point would be 1% of your loan amount. If you had a loan amount at $200,000, that would be $2,000. So the borrower would pay a premium of $2,000 to walk away with that 4.25.
That's right.
If the par pricing was 4.5, that's just an example.
That's right.
And the opposite could be true of what if the borrower says, well, I want to pay the least amount of cost as possible. I could say, well, the bank will give you this shiny 4.75%, right? 4.75%. And it will actually give you a $2,000 credit towards your closing costs.
That's right. I actually had a borrower today I was working on. It's an FHA loan, and he's going into a condo. So there's about $3,500 worth of extra closing costs involved in this deal. Mm-hmm. And he said, Tom, I want your at par pricing. And I also want to know what interest rate could I get that would generate a credit enough to help cover those condo costs. And so I figured it out. It was probably about 0.5% higher is what we had to do in order to generate enough of a credit. So I think this makes sense for everybody.
Yeah, I think so. And I hope so. If anyone has questions on it, just rewind it and hopefully it helps. And of course, just ask us anytime. We're here to help. Also, when you hear commercials, everyone in the audience, when you hear commercials that there's no closing costs, that's just a gimmick. All they're doing is raising the interest rate and giving you that credit we're talking about.
That's right. So that's a really good point.
Oh yeah, we don't charge any closing costs. Well, that's a bunch of baloney. That's just that's crap. And you'll hear it in marketing all the time. You're going to get flyers from it. No closing costs. Free this, free that. Nothing's for free. The bank knows exactly the profit they want to make, and they'll just give you that shiny higher rate with a lender credit that basically pays your costs.
That's right.
Okay.
Well, is that anything else we need to cover, you think?
I think we're good. I think we've done enough damage today. Enough work is done.
There we go. Let's go home.
Yep, that's right. See everyone.
Okay. Thanks, guys.
Hey guys, thanks for listening to the Mortgage Brothers Show. Please let us know if you have any questions you'd like us to answer on this podcast. You can email your questions to Tom at azmortgagebrothers.com or yours truly at Eddie at azmortgagebrothers.com. And be sure to ask us for a free quote on your next mortgage. Tom and I will personally work with you and help you through the whole process. Signature Home Loans, LLC does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917 and 1618695, Equal Housing Lender.